Welcome to Finance with Factor,
Oops, apparently we're already recording, so here we go.
a place you can come to laugh and learn from local experts who love to discuss everything related to the world of real estate.
Weird passion. It's one that I actually share a little bit, so it makes me a weirdo with you.
Each week, we'll cover a unique topic
Let's talk about condo.
to help you understand the mortgage industry, navigate the home buying process, and grow your business while maintaining a slice of sanity.
Okay, fine. I've been confused by a lot of things over the past few years.
Now that he's climbed safely atop his soapbox, here's your host, Jason Factor.
Thank you for joining this episode. I'm so excited because we're going to talk underwriting and guidelines and real mortgage in the weeds stuff. And before you turn that off, I promise this is going to be interesting. There have been some really significant changes, particularly on the condo side of mortgage lending. And if you are in a market where you are buying, selling condos, townhouses, apartments, anything that isn't a joint association with other homeowners, this episode is going to be important for you to just sit down and listen to, even in the background as you're driving around. I am excited to be joined by the head of our condo department. Full disclosure, I work at Northpoint Mortgage, and this is the head of the Northpoint Mortgage condo department. So thank you for joining me and welcome to my podcast.
Thanks for having me.
Before we get going, would you mind sharing a little bit about yourself, your background, and why the heck you've dedicated your career to condos?
I think like a lot of people in this industry, I kind of fell into it. I've been doing, between real estate and mortgages, I've been doing this for over 30 years. I stopped counting at 30. Switched from real estate to mortgages probably about 25 or so years ago. And then somehow about 10 years ago, I found myself just in the condo world exclusively. I was an underwriter, am still an underwriter. And found that this interested me. And a lot of underwriters didn't want to bother with condo, not bother, but you know what I mean, with condo loans. They were
because
kind
it's
of
different,
complex.
right? It is different.
There are added complexities there, and it just ended up something that became a niche for me, and then we went from there.
So I think we'll start with some misunderstandings or misconceptions, I guess, and we'll work through some best practices, and we'll certainly walk through the changes in the underwriting world regarding condos. But before we get going, I think just the basic concept that people misunderstand is that when you're buying a condo, you're actually getting underwritten twice. The underwriter will underwrite you, the home buyer, and your qualifications to buy this particular home. But then there's this whole other process that we are going to underwrite the association itself and the apartment that you're buying. Why?
Absolutely. Because there's two layers of risk. You've got the layer of risk that is the borrower, the credit risk. We want to evaluate income, assets, those kinds of things on the borrower side. But then buying into a project, a condo project, you have all these other people and things that you need to worry about. They have their own set of financials, their own set of legal docs, their own insurance. There's a whole host of other issues that come when you buy into a condominium complex. So we have to look at the project itself. Is it financially stable? Is it formed in a legal way? Is there any kind of restriction in their legal docs that is against what guidelines allow? So yeah, there are two separate, completely different processes on every condo loan.
And to rationalize that for people that are listening to that and seem that maybe that feels invasive or overkill. In the same way that if you buy a house and your next door neighbor's house looks really terrible, that can impact your marketability. Keep in mind, banks assume we're going to foreclose on you because obviously we're going to foreclose on you. It's our burning desire. No, it is what the bank has to go in, assuming that we are going to have to assume this property at some point. It's an investment. You wouldn't give someone a couple $100,000 without doing your due diligence. And if your neighbor's property can impact the value of your property, the bank wants to know, is your neighbor responsible? Because we're technically only underwriting you as the homeowner or the buyer. So understanding the association that you're buying into becomes that much more important.
Right. Exactly.
With that in mind, what are, you said meets guidelines. There are sort of the idea of a conventional guideline, and then there's everything else. Can you walk
Right.
us through a little bit of what that difference is in terms of conforming and non-conforming? People will hear things like, oh, you need a portfolio loan for this, or oh, this is conforming, or this is non-conforming, or unwarrantable. Can you
Mhm.
define some of those terms for us?
Sure. Sure. So the most prevalent, I think, at least certainly in our market area, are guidelines established by Fannie Mae and Freddie Mac, the two government-sponsored entities that set financing guidelines for a large part of the lending public. They have a set of guidelines that we have to adhere to as far as budgets and their legal docs and master insurance policies and things like that. Uh, HUD has their own set of guidelines. Those are still warrantable condos. If somebody has an FHA loan, and then we have to follow HUD's set of guidelines. If a veteran wants to buy a condo, there's a set of guidelines that we have to adhere to for VA. Anytime a project doesn't meet a guideline for their respective purchase type, financing type, then we have to consider that a non-warrantable condo. And that's where those portfolio loans come in, where local banks sometimes will have different guidelines, or we have, as you know, access to a whole host of what are called non-QM lenders that will step outside of the regular guidelines and allow us to lend in projects that might not meet Fannie, Freddie, HUD, or VA standards.
And I think it's really important just to note the idea that most places, I always say mortgages are, I actually have a framed picture on the wall behind me. It says mortgages are like pizza that my kids made for me, because I annoy them with that saying all the time when they hear me say it. But it really is. Every bank is making pizza. Every condo, every bank kind of follows those conforming guidelines, and then they add their own
Right.
layers of risk, right?
Right.
They add their own ingredients on top of it. And some might be more forgiving and some might be more restrictive. And so finding the right recipe for your condo is really important. It's the biggest pet peeve I have is when someone tells me that they have a generic pre-approval letter and then they're shopping for condos,
Right.
because it does you no good. That letter is
No.
totally useless for
Right.
so many reasons. Can you outline some of the risks for us and some of the things that you see commonly when underwriting condos that can become tripping points, and the reasons that using a generic pre-approval to buy a condo is so risky for buyers and realtors?
Sure. Well, I mean, we'll start with the fact that all of those aforementioned government entities, Fannie, Freddie, HUD, VA, all have lists that they maintain of projects that are either approved, have no status, or could be ineligible. So if you've got a pre-approval letter that is generic like that, there's no knowledge as to whether there's staff at that particular lender who issued that pre-approval letter, whether they've checked those places. What condo project are you thinking you might be interested in? What projects, I should say, do you
Yeah,
think you might be interested in?
when
Has
you're out
anybody
shopping with
looked?
a generic letter, you probably didn't have a place in mind. So how could they even
Right.
know what the condo fees were, let alone the restrictions on that unit?
Exactly. And so, if you're not working with somebody who is asking those questions, where do you think you might buy? Give me, let me know where your realtor's taking you this weekend. Let me look up those projects. Let me tell you if there's a known problem with one of them. And we also maintain our own internal database of projects that we've reviewed. But there are so many stumbling blocks to project approval that I see all the time. Fannie and Freddie have guidelines with critical repairs. We can dive into what that means. I see problems with that all the time, with their master insurance, with their budgets. And with the guideline changes that you referenced, we're going to see more, I think, of a transition period for the next 6 months to a year, where projects that might today be okay, and in 2 weeks, when the first set of guidelines changes, might not be. And then come January, when there's more change, there'll be an additional set of projects that no longer qualify.
All right, we've teased it long
I
enough.
know.
Let's go into let's get in the weeds. So, one of the things that has already changed, it changed earlier this year, was
Mhm.
the idea of the longstanding myth that if you're buying a place, what's the owner occupancy ratio?
Correct.
That's no longer really, the owner occupancy ratio was never really that huge of a concern if you were the owner and
Right.
you were buying it as a primary. It was really only a concern if you were buying it as an investment condo, because you couldn't
Correct.
have over a certain number of investors in the building if you were buying the investment unit. or the unit as an investment. But that condo guideline has now gone away. So
Correct.
we no longer are concerned with how many investors are in the building, which is funny because the whole thing was to make it more affordable for home ownership. And that was why they were pushing these changes. And then sure enough, like investors can now swoop up units at a higher rate. But that's a side point. What are some of the changes to condo guidelines beyond that one that are upcoming that people should be aware of as they sit down to start planning condo budgets for the next year?
Yeah, absolutely. So can we just backtrack for 1 second
Oh,
for
yeah,
what you
please.
just said too? I want to clarify that the investor occupancy ratio went away for Fannie Mae and Freddie Mac. It did not go away for HUD and VA. So HUD and
Good
VA
correction.
still have owner occupancy guidelines at 50%, at least 50% owner occupied.
Well, and that's actually another myth that we should address before we dive into my last question.
Oh, sure.
The idea that you can't buy a condo with an FHA loan or a VA loan, total myth.
Totally.
What
We
does
do
the
them,
process look like to buy
we do
a
them all the
condo with a
time.
VA or FHA loan?
So VA is easier to go over because VA doesn't publish their condo guidelines. Anybody who's been doing it for a little while knows that there are things that VA doesn't like, but there's only a couple that they are hard stops for them. What we have to do on any VA condo is look it up in their database, and if it's approved, great, problem solved, moving on. If it is not in their database yet, then we have to submit it to VA. VA has to review it and decide what's going to happen. Even
Which
if
can
VA
take a
doesn't
matter
like
of a
it,
couple of days to a couple of weeks. It's
well,
not that intrusive of a
it's
process.
it's not an intrusive process. It's right now, historically, it has been quick. Right now, it is not. I believe they have staffing problems at the VA. They don't have the volume of staff that they used to. So it's a little bit delayed, but still very doable. As long as proper expectations are set, we're fine. And even if VA doesn't like the project, there are only a couple of reasons where they won't lend in it. They may not like it. They may reject the project, but they often will allow the veteran to sign a waiver acknowledging that this is VA's issue with the project, and they accept that and move on. HUD has a few processes for condo approval. There are some that are on their list as already approved. There are some where they offer what's called a single unit approval. It's a bit of a misnomer. We're not ever only looking at that one unit. It's always a review of the whole project, but it doesn't require full project review. The difference between the two being documentation. The volume of documentation you need is much less on a single unit approval. Can't do those on new construction. Can't do those if there's more than 10% concentration of FHA loans already in the project. But we do those all the time. The benefit to Northpoint is if it does need a full project review, that process is a lot more documentation, takes a little more time. Most companies have to send those to HUD for their approval, for their review and approval. And HUD has 30 days to review a project you send them.
Which again just comes down to expectations and timelines and being upfront with the pre-approval with both the borrower and the seller to say, here's what we expect this to look like. And then navigating the timeline, the rate locks, and your quotes and pre-approvals to make sure that all of that is accounted for in the process.
Exactly. But the beauty of being at Northpoint, the beauty of choosing us, choosing you, is that I have DELRAP authority, and so does the person who works with me in my department reviewing the condos. And what that means is that we've reviewed 8 million condos for HUD, and we have authority to review and approve those, put them on HUD's list ourselves, bypassing that potentially long 30-day or more wait to get a project FHA approved. So not only is it not impossible, it is right. It is so much more doable here than it can be at a lot of other mortgage companies who just don't have the staff or knowledge to do that. So yeah, we do that here. The single unit approval process has taken away a lot of full project reviews because they're not necessary anymore, but we still do them. We still add projects to the list.
Well, I'm going to touch on a few points there that you just hit on. One, underwriting condos can be tricky, particularly at some institutions. Mm-hmm. I have always been fortunate enough to work at places where we have access to people like Cea, where we can go directly to a source to underwrite it. When it is a whole department that is some nebulous body at a bank, it can be a real struggle. For example, one of my best referral partners used to be a loan officer at Bank of America who would be like, it's a jumbo condo. We're never going to get it done. Here you go. And that's sort of the crux of it, is that, again, like those timelines can just stretch on if you don't have direct access to the person who's making some of these underwriting decisions, so you can have the conversations. Or some of the delays that you get when management companies don't get back to you and you need to hound
Right.
people for documents, or they fill something out incorrectly in the process. It can really drag on. And if you don't have a actual person on your team like Cea, who's staying on top of that for you and really keeping us in the loop as to, hey, get Realtor X to follow up with their seller. We need this
Right.
document. Then it can really become a problem for timelines.
Yeah, absolutely.
The other thing
Without
I
a
want to
doubt.
circle back on is you mentioned
Oh, yeah.
the word full review. That's actually one of the guideline changes. Can you touch on what that means, full versus limited review, and what some of those changes mean?
Oh, sure. Sure. Yeah. I mentioned it for HUD, but it does also correlate to conventional, to Fannie and Freddie. And what that means for Fannie and Freddie is right now, as we sit here today, Fannie and Freddie have two types of review if the project isn't already approved. And, we have other stuff we could talk about, but Fannie calls it limited review and full review. Freddie calls it streamlined and established reviews. And the difference between the two is, again, the amount of documentation. Basically, if you qualify for a limited review, and that's based on occupancy and LTV, if the project and the borrower qualify to do the limited review, then there's no budget review. Really, there's several questions that don't have to be answered, but really the big difference is we don't have to look at the financials of the project.
So we'll
And in a
still do
full
a
review,
questionnaire. We'll still
still
do
questionnaire, still master insurance, just no budget. And with a full review, it's more questions, a budget, and you have to be so with the budget comes reserve requirements and contributions and things like that.
meeting notes, things like that we might have to
Right.
pull.
And, obviously critical repairs come into both of them. So, yes, depending on how they answer those questions, we may need meeting minutes. It gets into a whole thing. Well, earlier in March this year, Fannie and Freddie both announced that they are retiring the limited review process. They felt that the lack of financial review was too harmful to allow it to continue.
And this
So,
is almost a direct result of some very juicy headlines where you've seen apartment buildings collapsing due to disrepair and things like that. We've had some even here in Boston that have been quote unquote condemned. We saw the one in New York that crumbled.
right.
Famously the Sunrise down in Florida that fell apart. And so that's where some of these limited review processes are going away. But it's also because of the other guideline that they passed regarding budgets. What was the change to budgets themselves?
So the budgets, that's a big change. That's going to be
It's a
huge.
huge change.
That comes January 4th of
PSA,
2027.
everybody who is listening to this episode, pause what you are doing and listen to this if you live in a condo. This is actually important. If you are on a condo board, if you are a realtor, if you live in a condo, make sure to listen to this next part. Go ahead, Cea.
Okay. So effective January 4th, 2027, but condo budgets have to be contributing a minimum of 15% to their reserves. Currently, the guideline is 10. In January, it'll be 15. The reason that that's so important now is that now is the time of year where boards are meeting, management companies are meeting with the HOA boards to discuss future budgets, whether you're budgeting on a calendar year that starts in January or you budget on a different fiscal year that's starting soon. You need to have these guidelines in place. I'm sorry. You need to have these budget changes in place to meet those guidelines that are coming effective January 4th, because limited reviews go away in a week and a half. So that's step one. Any application dated on or after August 3rd, no more limited review. We have to look at your budget. Come January, we add into that now that budget that we're looking at on every review has to have a 15% reserve contribution. Huge
What
change.
does it mean if they don't meet that guideline? What happens?
So if they don't meet that guideline, our only recourse is assuming they have to have a full review. We can touch on waivers of review and who they apply to, but assuming they need that full review now, their only recourse to get around that reserve requirement is a reserve study. A lot of projects have them, but a lot don't. They're costly. They can be several $1,000s. And what a reserve study is it's usually done by an engineering firm or a financial company, and they come in and they really dig deep in your financials, in the physical status of your project. They evaluate everything. And then they give you the report is dozens of pages, sometimes hundreds, depending on the size of the project. And it tells you what you should be saving every year.
If you're not in the
So,
mood for a full condo enema, then I highly recommend you sit down with your board and ask them what they are setting aside for reserves and
right,
and inform them that it used to be a 10% reserve requirement and now it is a 15% reserve requirement.
right. And
The
if your
reason this
reserve
is so
study,
important is because if you don't do it, every single unit in your condo association now becomes tagged as unwarrantable, which means
right,
it just
right,
became more expensive for all, usually, or at least it's a more limited pool that you can
right.
sell or sell your condo to a home buyer who wants to buy your unit or to refinance your unit yourself.
Right. Because that reserve study is our only way of getting around that. And you would have to be making, it would have to be so that the highest reserve recommendation mentioned in the study is less than the 15%. And that's what you're making. The instances of that happening, that guideline exists now even for the 10% contribution. I
Mhm.
can tell you that in my career, I've had that work one time.
I've seen a few. It's usually when you have a huge amount in reserve, right? You've got this
Right.
big balance with no
Right. But
projects
that,
coming up. But
yeah.
then that's a poorly run association to begin with, because why should your management company be holding on to hundreds of thousands of dollars
Right.
that aren't being
And your
used?
reserve balance doesn't matter. It's what you're contributing every year. You have to
Correct.
be continuing to make that contribution. So it's huge. You're right. It's huge. And to expand on what you said too, the ramifications of not meeting that guideline are non-warrantability. And then I am required, our contract with Fannie and Freddie requires me to notify them if I find a project for this reason or any other that's non-warrantable. I have to notify Fannie and Freddie. They put it on their list as ineligible until the issue is resolved. And then conventional loans for your purchases, but also your refinances are gone in that
Yep.
project until you fix that problem. And a problem for Fannie and Freddie is often, not always, but is often a problem for HUD and VA too.
So if
Um,
you bought a condo in the last 3 years with the idea that rates were going to come down, and they haven't, and so you want to refinance in the future, and you are positive the rates are going to come down in the future, which they might, who knows?
right.
But
Yep.
if you're banking on that idea, you better make sure that your condo association is being run to the new guidelines. Otherwise, you're going to see rates drop, try to take advantage of it, and get locked out because you're
Right.
not able to refinance on the products that you think you can. And suddenly it might become more expensive, or more importantly, you might get into the process. And I see this a lot. So, for example, I'll give you one quick example. There was a bank, I'll leave it unnamed, that we used to have in a portfolio at a previous company. They had this weird condo guideline where they wouldn't do, again, go back to what Cea was saying at the very beginning. Condo underwriting is an evaluation of risk. And this particular bank said, we don't really want the risk of newly developed renovated condos. So, in other words, if the condo had been gut renovated within the last 12 months, it didn't meet their condo guidelines. It's not the way they make pizza. They just don't offer that option,
Right.
which is a lot of condos in this area, particularly where you see new conversions. And so they would, you get a pre-approval letter, you go out, you shop, you find your brand new apartment or condo or townhouse, you make your offer, it gets accepted, you're super excited, you submit everything, you get approved, it gets into condo underwriting, and a week before closing, suddenly you're denied because according to the questionnaire and the survey that they filled out, this place has been converted or got renovated within the last 12 months.
Mhm.
Now you're panicking, looking for a new loan, new lender, or the deal falls apart. So, understanding your condo guidelines for your particular unit and your loan that you're being quoted is very important. Now, I had lost that client because I had that particular bank in our portfolio of options and I didn't quote it, even though it was the best rate. And then they came back and like, well, we're going to go with bank X because it has a better rate. And I was like, I know it has a better rate. You're just not going to qualify.
Right.
And
Right.
sure enough,
They can't do
two
your
and a half
loan.
weeks later, they got denied. They called me back. They were like, what do you have for us? And I was able to get them into something and get them approved quickly. But the reason was because I didn't quote them that rate because I knew they wouldn't qualify for that particular home with that particular program.
Right. Because not everything works.
What are some of the biggest tripping points that you see other than the expectation for this budget thing? Because I think the
Right.
budget thing is
Right.
going to trip up a lot of units.
So master insurance, there are certain coverages that a master insurance policy has to have. Sometimes they don't have them. Often we can have a conversation with a management agent or somebody from the board of directors, explain the ramifications are the same. You go on the list as ineligible. We explain that to people, and often they're willing to make those changes.
It's usually the per unit deductible, right?
That's a recent guideline change too. So that's less of a problem now because the guideline changed. There used to be a calculation that we had to do to determine if a per unit deductible was acceptable. We ran into problems left and right up until March. And in March, that guideline changed that said now we can, with a per unit, if a master has a per unit deductible, the borrower can offset that with an HO6 policy. So that became much less of a headache. These days, there are just coverages that they don't have, whether it's something called building ordinance or law, or whether they can. Sometimes they just can't or won't confirm that the replacement cost on the master insurance policy is equal to what it would actually cost to rebuild. We have to verify that, and some can't or won't. Master policies are a stumbling block sometimes. I would say, though, that the biggest problem we run up against is the critical repair issue. Ever since the Surfside collapse years ago, Fannie and Freddie both put into play new guidelines for determining that there's no outstanding critical repairs or deferred maintenance. And there's not a lot of flexibility with how those things are determined. So we are bound by those guidelines, and we need certain things. We need to verify that those things, first of all, don't exist. And if you won't answer those questions, which there are still, all these years later, there are still HOAs and management companies who won't answer the questions, we then have to ask for your meeting minutes. And Fannie and Freddie both say 3 years because the look back period for reports and things like that is 3 years. So if you're not answering the questions, I'm asking for meeting minutes, and that's 3 years worth of meeting minutes. And when I say it to them all the time, nobody wants to ask for 3 years of meeting minutes less than I do, because I'm the lady who has to read them all. And when I tell you that's my least favorite part of this job is reading 3 years of meeting minutes. It's crazy. And inevitably, those meeting minutes raise more questions than I had at the beginning that you now have to address.
The last thing you want to do is give the bank something you don't need to give them. Please don't give the bank a reason to look into stuff.
Do not tell me about water seepage that you were having in a building 5 years, almost, not 5 years. It would only be 3 years.
Especially because those meeting minutes, those are just homeowners complaining.
Exactly.
So they're going to tell you about everything, whether it's worth looking into or not. It's going to show up in the meeting minutes. Joni complained about the kitchen sink that linked into the unit below. And it's like, it's fine. It was resolved within a day.
It was resolved. They replaced the pipe. The plumber was out the next day. It was fine. But now you have to prove that.
But now you have to go document all of that.
Right.
So
that is probably
the
biggest headache.
Answer the questions, people. Answer them correctly to the best of your knowledge. And if you don't know the answer to something, call us and ask.
Right.
We will help you.
We're not expecting, you are no more an engineering expert than I am. We're just asking you, to the best of your knowledge, do these things exist? And they're just basic questions. Do you know about any deferred maintenance? If you're unsure what deferred maintenance means, call us and ask or Google it. It's the same as owning a single family home. I could tell you if there's deferred maintenance in my home or not, to the best of my knowledge. But But does that mean my house is going to fall down tomorrow? No. I mean, there are certain things that are problematic and there are things that aren't. If you have structural issues, balconies, support beams. I had one recently that mentioned the support beams in their garage structure, their attached garage structure. Those things are problems. Needing to replace a roof or roofs on multiple buildings because they're failing. You didn't replace them because you probably weren't setting aside enough money in your reserve account. You didn't replace them when it was end of life, and now you've got water intrusion into multiple buildings. That's a problem.
Which brings us to our next subject, which is a subject called special assessments. And I will keep this very brief, but the only client I've ever fired in my life, someone who actually said, please stop calling me, I think you should go with the other lender, was this guy named Jeff. For those of you who have listened to Finance with Factor episodes in the past, you might have heard the story of Jeff, because Jeff was a jerk. Jeff is the reason that you need property-specific pre-approvals. Jeff was retired. He was living on a fixed income, and I remember very specifically where I was. I was at a brewery at a Bills-Pats game in Buffalo with some friends. It was 10 o'clock on a Saturday before the game, and he calls me. I need a pre-approval for $650 for this unit in the West End of Boston. I was like, we've talked about this before, Jeff. I can't give you a pre-approval for $650 for that unit. He's like, that's blah, blah, blah. You gave me a pre-approval for $650 on that other unit. Why can't you give it? And I'm like, Jeff, we've talked about this. It has a $1,500 a month special assessment. Special assessment is exactly what Cea was just talking about, deferred maintenance. In this case, they need to repoint a giant building and redo all the windows, and there was a $1,500 a month special assessment on his unit, which would have meant his condo fees would have ballooned to over $2,000 a month. And when you get pre-approved, what you actually get pre-approved for is a monthly payment, not a purchase price. He couldn't afford a $2,000 a month condo fee on top of his principal and interest and insurance payments, taxes. By the time it was all said and done, it was way over what I could approve. So I said, I cannot give you a pre-approval for $650 on that unit. He, sure enough, after blustering and threatening, I say, do it. Go with the other company, who I will leave unnamed. He goes with the other company, gets his pre-approval for $650 because he is pre-approved for a purchase price of $650 at a condo
With
fee of
certain parameters.
$350 and blah, 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 right? And then 2 weeks later, I get a call from the realtor. And again, I won't mention his name either, but the realtor's like, so when you denied Jeff, what did you say or give him? And I was like, well, technically, I never denied Jeff. Jeff is well qualified. Jeff can get approved for a purchase price of $650. I was like, I will direct you to legal and they will write you something. Because it turns out Jeff lost his deposit and he was suing everybody. And I was like, yeah, that sounds about right. The personality fits.
Right. And he knew, but he'd already been told.
Yeah, but I was like, I can tell you, I will put you in touch with compliance. I'll put you in touch with legal. They can write something up for your defense, but you should not be liable for this. I had told him he was not going to qualify for that particular unit. And it is full circle to what we've been talking about this entire episode. It is so much about property-specific approvals when you are out shopping for condos.
Right.
You just have to do your diligence on the unit.
Because those special assessments can be, sometimes they're not always a deal breaker. Just because a project has a special assessment, not a deal breaker necessarily.
It's also all negotiable. I just had one where the seller paid it. Right. We said, hey, there's $2,000 left on this special assessment. My borrower doesn't want to take it on or can't afford it. Let's make it part of the proceeds. Let's make it whatever it is, right? There are ways to negotiate all of this.
Right. But sometimes we always have to ask about them because from a condo project review standpoint, often it's in the special assessment that we find out about those concerns of deferred maintenance or critical repairs. Not every, sometimes they're just building up their reserves with a special assessment. Totally fine.
Correct. I myself own a condo in Somerville. We are building up some reserves because we know we need to redo the driveway soon. It's fine, but it's been cracking and falling apart for years. And so we are setting aside a couple $100 a month that we save up so that in a couple of years we can redo the driveway.
Totally fine. We would approve that all day long.
Yeah. So what are some of the things, let's talk about as a listing agent, if I'm an agent, what are some of the best practices that make your life easier as the underwriter for a bank underwriting condos? What are some things that realtors and sellers can do to help their sale go through smoother?
The biggest thing you can do is reach out to somebody like Jason. Reach out, ask the question. Hey, I want to list my condo unit. Can you look up my project and tell me if you are aware of anything that might be a concern for me? And ask the seller. If you're the realtor, ask the seller, have you attended your recent meetings? Are you aware of any major issues coming up? Are you visually aware of any physical damage?
Ignorance is not bliss as the listing agent when it comes to condos.
No.
Because
make a phone
we will
call.
find it and then we'll have to address it.
So call. I'm happy. My team is happy to look up projects. They're not those databases that I mentioned before for Fannie and Freddie are not publicly accessible. Fannie has recently made some changes where they do have a database that HOAs can apply to access. I can't apply to do that because I have our access. So I haven't yet been able to see what they can see from their side. but they are not largely publicly available. Certainly, even if somebody could access some part of it, the detail of if something's ineligible, why, and can we overcome it? So, have a conversation with me, call you, who can then have a conversation with me and say, do we know of anything?
One of the best things that I tell realtors to do all the time, in my opinion, one of the best things you can do, one thing that is publicly available is the form for condo review.
Caution that it's old and Fannie has not updated it. And there are questions that they require an answer to that they have not updated that form to include. But
Okay,
it is
there
a
you go.
starting
Even I learned
point. Or, we
Yeah.
have forms that we update all the time.
So I update my recommendation. Follow Cea's advice. Call your go-to lender. If it's me, that's your best lender. But if it's someone else, that's perfectly fine. Call your go-to lender. Have them give you their form for their condo questionnaire. Fill it out. Ask, who is the trustee? Who is the management company that can fill this out? Have them fill it out. Throw it in MLS as one of the documents
100%.
that you put up there so that every buyer that's coming in to look at it has
Knows
that to look at.
Huge.
So
That
their
would be-
lender can review it
I
and
don't
make
know it-
sure that it fits the guidelines for the product that they're offering for their buyer.
I don't know anybody who does that. You'd
Nobody
certainly be
does.
setting yourself apart. If
I
you
tell
gave
realtors
that-
this all the time. You want to win more condo listings? Follow this advice. Get a condo questionnaire, have your management company fill it out, put it in MLS as one of the documents, and then you can go to your buyer and say, every single person that comes in here and makes offers now has the information they need to make sure that this offer is going to go through. And if their lender is doing their due diligence and you as your realtor are doing your due diligence and calling the lenders to make sure that they've reviewed the documents you've uploaded, well then great. Your offers are going to go through super smoothly.
Right.
That added risk, such a value to your
And
if
if you want to make it even better, add to that questionnaire your current budget and a generic, certificate of your master insurance. Throw those 3 things, you would impress. Oh my God, I'd be so impressed. If you said, hey, my borrower wants to buy this condo, can you take a quick peek at these, at this budget, at this master insurance, and at this questionnaire that they've already had completed, I would probably fall out of my chair if somebody provided that to you.
And every pre-approval that comes your way, it should be solid, right? Like you've now taken a giant element of risk out of the equation.
Right. 100%.
Well, thank you, Cea, for making time to do this. I know it's a busy time of year. It's a busy day. It's a busy week. It's a busy month. But I really appreciate you taking time to do this. We are happy to go on tour.
I am on tour this summer. I say it all the time.
So
yeah, absolutely.
If you want the traveling band to come to your association, review documents, heck, I'll provide cocktails and snacks, and we can sit in on one of your meetings, particularly if you're a larger association, and go through, here are things that we found that you guys need to address as you're planning next year's budget. We can tell you all the things that you need to make sure that your condo and all of the owners in your association are in a good place to buy and sell units within your association. And it is a huge value add for your association. So please.
Huge. And let me just say, that same goes for realtors. If you are a realtor and you are part of, your local board of realtors or just your office, you feel like there would be value in having us come out and talk to your realtors and help them, with this information, answer questions. How often do you get a one-on-one with somebody who can answer all your questions about your condo stuff? We're happy to come out. I do it all the time. I'm doing it, all summer long. And I mean, I'll do it all year, but I'm just saying I've got a lot on my books with the changes coming.
Again, with the changes coming, and if you really want to set yourself apart as a realtor, invite us out. Like, have us come out. We'll walk you through all the things that you can do to make sure that you win that next listing for that next condo. Because I assure you, most realtors aren't doing this level of due diligence when they go in for a listing appointment.
They don't even know that there needs to be due diligence a lot of times. They don't understand the fact, like we started this all with, that there is a separate review. They don't understand the complexities involved there.
And if you are one of the people that do understand it, well then leverage the heck out of that and applaud to you, because well done. You're one of the people that we want to work with. Thank you so much for listening. Thank you so much for your time.
Having me.
And see you again next week.
Thank you for listening to this episode of Finance with Factor. Please remember to like, share, and subscribe. Then if you really like us, open another podcast app, Apple Podcasts, Spotify, or really wherever else you enjoy podcasts. Search Finance with Factor and do it again. The more places you like, share, and follow helps our ratings. But that can be our little secret. Have a question about today's episode or an idea for an upcoming episode? Post a comment. For more content, follow Jason Factor on YouTube, Facebook, and Instagram at Finance with Factor. All content discussed on Finance with Factor is self-published by Jason Factor, Senior Loan Officer, NMLS number 1401985. All rates, guidelines, and advice shared on this episode is subject to change. To contact Jason directly or for a full set of disclosures, visit his website at jasonfactor.com.
Jason Factor, NMLS number 140185. Northpoint Mortgage supports equal housing opportunity. NMLS number 1515. NMLS Consumer Access Star. Go Factor!